painting by René Magritte. So it's called La Clairvoyance, which informally could be known as perception. And what it does is it shows the skill that we believe separates my firm, Loh-Gronager Partners, from all the other investment firms out there, and indeed successful investors from the rest. And that is perception. So for the benefit of anyone in the audience, I appreciate I haven't got a copy of the painting on my wall behind, but now would be a very helpful time to have it. So for anyone that's unfamiliar with the painting, I'll just describe it briefly. So in the painting, the artist is pictured seated in a chair, and he has the canvas on an easel in front of him. And on the left-hand side of his body is a table with an egg on his left. And the artist is looking at the egg. But on the canvas in front of him, he's painting a fully grown bird in flight. So for many people, as it was for me when I first saw it, at first glance, the painting, like almost everything in the investing process, appears fairly simple. However, that simplicity is very deceptive, because the closer you look, the more complex the subject matter becomes. Investing is a zero-sum game. Success comes from seeing things that others don't, whether that's correctly identifying an enduring moat around a business or recognizing the growth opportunities open to a company which haven't been discounted in the share price yet. And the ability to correctly predict the future price of something, which relies only on current and past information, really is the hallmark of a successful investor. And what I find is that most investors are first-level thinkers, especially when they begin. So when presented with an egg in this example, as in the painting, they treat it as an egg. But like the artist, it takes a particular focus and insight to be able to study the egg and see through it to the fully grown bird in flight. And that to me is second-level thinking. So for me, perceptive investing is the ability to review all of the incomplete data sets available in the market, and then through intense focus and insight, being able to project forward a different outcome from that's priced in by the market.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Ardal Loh-Gronager. He's the founder and managing partner of Loh-Gronager Partners Investment Partnership. He brings over 10 years of financial industry experience from roles at Goldman Sachs, Morgan Stanley, and Credit Suisse. He's half Danish, born in the UK, with a global upbringing across Europe, Asia, and Australia that shaped his unique perspective, while his entrepreneurial ventures and deep study of value investing with pioneers like Warren Buffett and Charlie Munger shaped his distinctive investment approach, which he now applies investing for the partnership. Ardal, so nice to see you. So happy to have you on the show.
Thank you for having me here.
Well, I got to meet you and shake your hand at ValueX, Guy Speirs ValueX, not long ago. You gifted me a book with Guy's blessing that I have with me here today. And you know that I read it back to back. And I absolutely loved it. And I was trying to explain why. And I told you that it brought me back to those early days when I discovered investing, 25 years ago. And I picked up One Up on Wall Street by Peter Lynch. And your book is one of those books that remind me why I do what I do and why I'm so passionate about investing. So thank you for writing it.
Well, that's incredibly kind of you to say. To get feedback like that as a first-time author, it really does mean a lot.
Well, I hope it's one of many. I want to jump right in. I have 1,000 questions about the book, but I have a question about you. And you talk about those early days. You grew up in many places, went to many different schools. You started businesses very early on. Tell me about that period, how it shaped you. I want to also understand your relationship with money and how that time shaped your perspective on life, investing, and business.
So just a small question to start with.
Yeah, small one.
So, well, I'd say that you're right. I think my upbringing is relatively differentiated, in that I lived in 11 different homes. I went to 8 different schools in 6 different countries before I turned 18. My parents, the main reason why we traveled so much was my parents were entrepreneurs. They started lots of different businesses in many different locations around the world. And they also believed in spending any excess income they had on sort of exposing me and my 2 younger sisters to the world. So we traveled a lot as kids. I think I took my first flight when I was only 2 months old. And then one of the things they joke about is that I was born at 6 a.m. on a Monday morning. So I was born ready to work. But, that aside, my childhood was far from perfect. Although it was a very good childhood, there were times where we had a lot and there were times where we had very little. And it's those experiences, I think in particular the painful ones, that have helped shape me into the person and into the investor that I am today. And I'm sure the same goes for you, Bogomil, and for everyone listening. When I say that we are all here today, the sum result of all the experiences that we've ever had, both good and bad. And I think, to take each of your points in turn, because it's quite a large question, when it comes to money, I think I realized very early on that it's a tool that allows you to do what you want. And when used appropriately, it gives you freedom to being able to choose how to spend your time. And I think that realization comes from learning the opposite, which is that if you don't have any money, you lack choice. And I had a personal experience when I was growing up when my parents had to take me in to see the headmaster of the school I was in at the time because they couldn't afford to pay the school fees. So at the time, I was only 11 years old and it felt like my world was crumbling beneath my feet, as it would for any, 11-year-old. Luckily, in that instance, the headmaster, he gave me an academic bursary so that I could continue my studies there. And that's a true act of generosity that I will never forget. But that experience seared into my mind that I wanted to be financially independent from an early age. And then, on the subject of business, I've said that my parents were entrepreneurs. So, watching them, I saw that real business is messy. Decisions often needed to be made on the fly, and the result of the decision wasn't always known immediately. Sometimes it took, a fair amount of time. And, no real business is run via a spreadsheet. So even today, I don't know whether it's the same for you, but, I stifle a laugh when I see these really elaborate 50-tab Excel spreadsheet models, made by financial analysts, and they use thousands of variables to try and precisely predict the future value of a business. And the only thing that I can tell you definitively about all those models is that their precision is that they're guaranteed to be precisely wrong.
That's right.
Tim Cook, the CEO of Apple, can't tell you what Apple's earnings will precisely be next month, let alone next year or 5 years from now. So what makes you think that you can forecast them indefinitely into the future as an investor? And I think it's that, as you can tell, by nature, I'm a contrarian and I'm very intellectually curious. So I think it was by trying as many things as early as possible in life that I was able to discover what my passion is for business and then focus all of my energies onto it. And I think that the earlier, which I'm sure we'll come on to later, but the earlier that you find your passion is an advantage to that because it gives you purpose in life, but also it's the compounding nature of knowledge, the same as I'm sure we'll talk about with money and with investing, is that your depth of knowledge, the earlier you start, it can't be surpassed by those joining later. So it gives you almost a competitive advantage or a moat, which is your combined knowledge there. And for me, my passion is business. To me, there's no better way of pursuing that passion though than through investing. And to be a successful investor, I know that you had to learn everything there was to know about success and investing. And I think that just remains true today. And that's what that intellectual curiosity and drive is so important. And then that brings me neatly onto, the biography of Buffett that Alice Schroeder wrote called The Snowball, that which I know that you've read as well, and many on the audience will have as well. And it reinforced in me that to be a successful investor, you have to have a passion for business, because how else are you going to craft your investment process? How else, how are you going to develop a differentiated insight into whichever businesses you want to research and identify value? And I think you have to fully embrace that ownership mentality and understand, just how unbelievable it is that any business that you're looking at, especially if it's founder or owner operated still, that it's still flourishing, because the difficulty of establishing a successful business it's almost insurmountable. And that's what I think is interesting for public markets investors. We just assume that these businesses have always been good and that they'll last for a very long time. And actually the inverse is very much the case. We're looking at the creme de la creme that end up being publicly listed. So, the environment within which a business operates is in a constant state of change, and nothing teaches that lesson better, I think, than founding or growing or starting your own businesses, especially ones that fail. And I've in my book, I detail quite a few of those, because only then can you really understand the Darwinian nature of capitalism, survival of the fittest. You can understand the power of competition, the importance of growing, a defensible moat around your business. And to be a great investor, I think you have to first be a great businessman. Investing is the very broadest of intellectual pursuits. It encompasses everything there is around us. And so for those who are intellectually curious and enjoy learning, I just don't think there is any better calling.
I love it, and I agree 100%. I already took half a page of notes just listening to you. But I'm going to touch on a handful of things that you brought up that I think are very, very powerful. People say, does money buy happiness? And you talked about choice, and I hear freedom. And I feel like happiness, it's up to you, but money definitely gives choices. You get to do things you want to do, and you get to not do things you just don't want to do. It's just freedom. And the precision, I tried to flip it on its head. I've been thinking about it a lot, how people don't like uncertainty. But I feel like there are different kinds of uncertainty. If I buy a stock at $10 and it could be $1,000, 100x, Chris Mayer's 100x, that's uncertainty too. But that's an uncertainty I'm willing to accept because I don't know if it's going to be 20x or 10x or 50x. Now, uncertainty where I lose money, that's a whole different picture, right? So I think the precision that we seek, it gives us some sort of feeling of certainty in places where it doesn't belong. I think it's fascinating. I want to highlight what you mentioned about investing as business ownership. I think the minute you realize that, you see investing in a completely different way. It's not a ticker, it's not a price, it's not a daily quote, it's not the headline and what the news reporter shared with you today. You're actually owning a piece of business. And you mentioned public markets. Throughout human history, if there was a business opportunity to make money, it was usually just for you and your family and your friends. You don't want to have outside investors. And there are many businesses that function this way today. The public market is unique that it allows all of us with a little bit of money or a lot of money to join and participate in somebody's efforts. And one last thing I want to mention that you brought up, businesses we see that are listed, they are few out of many that tried, that scaled, that failed, that never grew. It's just a handful. It's thousands of them, but it's a handful out of millions of companies that got started out there and never could reach the scale that those companies did. So I think it's something that I respect a lot once you see it. Not all companies that are listed are worth investing, but just the thought of it, the journey they took. You moved around a lot. And we have a mutual friend, Guy Spear, who also lived in many places throughout his lifetime. I lost count of places he lived in.
I think you might even beat me for the number.
I had him on the show. We had a fun conversation, and there's a question I asked him that I'll ask you at some point too. But you had a very memorable lunch with him. How much can you share about that lunch? What happened?
I don't think Guy would be upset if I shared everything about that lunch. So, for background, I won Guy Spear's charity auction, which he auctions every year on eBay. I think he'll appreciate the shout out.
Yes.
In 2023. And, my sole objective in purchasing the lunch was actually just to thank Guy.
Mm-hmm.
I'd found his book, The Education of a Value Investor, as well as all the things that he shares with us in the community, his thought pieces, his podcast, the interviews that he'd done. I found them really incredibly valuable for me when I was building my own investment philosophy and on my own journey. I think the other thing I should say here is that, I couldn't actually afford Warren Buffett's lunch at the time. And I think his last one went for something like $20 million. So Guy was my starting point. And if you won Guy's lunch, it could be hosted in London, which is where my fund Loh-Gronager Partners is based. So that was also helpful. But the structure of the lunch is very similar to what Guy told me he experienced when he won the Buffett lunch, and he won that one with Manish Pabrai back in 2007. So I was able to bring up to 5 guests. So I decided to bring the other members of my investment team. So I brought our Chief Operating Officer, Jamie Goodman. I brought our Chief Risk Officer, Derek Villarreal, and I brought our Chief Engagement Officer, Dr. Christian Jespersen, because I wanted us to have a shared experience with Guy where we could ask him anything that we wanted to ask him. And that opportunity to meet and speak with Guy candidly for such a long period of time, I think is just quite a rare thing.
Mm-hmm.
especially, with no recordings. So, you can ask him just about anything. So it's interesting because for me, the most memorable part of the lunch was when I got to ask why he auctioned a lunch every year. So he told me that he'd asked Warren actually the exact same question when he had sat down with Warren for their charity lunch. And Warren had said that it was an opportunity to give back, and that regardless of what was paid for the lunch, his job was to make sure that the person that had spent the money was having such a good time that they'd come away from the lunch thinking it was fantastic value for money. So, and Guy told us that was his objective as well. So, and he told us that it was that spirit of generosity from Warren that inspired both him and Manish to begin auctioning off at, an annual charity lunch. And then he then said that he wouldn't let me or any of my team leave the lunch until we had asked everything we could possibly ask him. So I'm not ashamed to say 4 hours later, we left the table, filled to the brim with food, drink, and also with knowledge. And I firmly believe that we can learn so much from, the people that have gone before us, because I think that all success in life, and also whatever field that you pursue, it's always built on the shoulders of the giants that went before us. And the same way that Warren inspired both Manish and Guy with his charity lunches, they've kind of done the same thing for me, which is why I've collaborated with the Financial Times Literacy and Inclusion campaign when it came to publishing my own book, and that's who all the proceeds are donated to, because Guy showed me that in whatever small way we can start giving at an early age.
I absolutely love it. And Guy Spear is a very special person. He's a good friend, and it's impossible to summarize my experience with Guy in a few words, but I share a lot of the things that you mentioned. He has a way of putting spotlight on somebody else. He always does it, and I think it's a gift. And the second thing about him is this open-ended kindness that's genuine, authentic, and unlimited. And I think between the two, I think it's just a nice life to live and a nice lesson to take away from him. Wouldn't the world be a nicer place if we treated each other the way Guy treats people in his circle and anybody that interacts with him? I think the whole world would be a much more enjoyable place to find ourselves in. But speaking of that experience and lunch and learning, I want to mention something that you bring up in your book, and you reference John Whitehead and this idea that you don't know something until you help somebody understand it. And it rhymes with Charlie Munger's idea that the best thing we can do is to teach somebody something or help somebody learn something, which is one of the quotes I included in one of my books. But you writing this book is an attempt, a very successful attempt to teach all of us something. Tell me about that experience, because it's something else to feel that you know it and to actually sit down and try to explain it to somebody else.
Yeah, I couldn't agree more with that sentiment, actually, Bogomil. And I think, actually, I'll give you a little bit of background that's not in the book to help to answer that question. So, when I was growing up, my father had a bookshelf of business books and biographies, and he encouraged me to read those. And I think, if memory serves me, the first one I picked up was a biography of Sir Richard Branson, who with no money up front had started Virgin Airlines. And he was taking on the mighty British Airways, who were the colossus at the time. And my father took a real interest in the fact that I was reading that book, and he actually organized a dinner, and I must have been about 11 at the time, and it was with a friend of his that actually worked for Virgin Airlines, and he was quite senior up in the management. And at the dinner, he asked me if I would present to his friend what I'd learnt from reading the book, and also what I would do if I was starting an airline. So I remember being put on the spot and, struggling for words. I'm sure I probably say it better today, but I remember thinking at the time, my argument was that, I would rather be Branson than British Airways, because Branson had, in my view, this unfair advantage that he could just fly planes on the profitable routes and ignore all the routes where BA was losing money, because why would you fly a plane on a losing route? And I was struggling with the concept that BA seemed to be more focused on being the biggest, but not the most profitable, whereas Branson was focused on just being the most profitable. He didn't care about being the biggest. And so that was actually my first lesson on business moats, that supernormal profits will, wherever possible, attract competition, and they'll eventually be drained away. And I think that was also my first experience of teaching, because it sort of compounded my knowledge after having read the book, a book on a subject. And it gave me additional clarity of thought, a depth of understanding that came through the exercise of teaching. So much so that I'm able to almost say the word for word what I said when I was 11, all that time ago. And that insight about clarity of thought through teaching is really the basis for my book, The Perceptive Investor, because what started as a lockdown activity, during the COVID lockdowns, to help me to clarify my thoughts on investing, it actually resulted in me having a better understanding of value investing. And it fine-tuned my own investment philosophy. So now, in addition, and after having written the book, I've begun to do presentations at high schools and at universities. And there I talk about investment, I talk about business, I talk about careers. And I'm hoping to collate these online actually and share them, hopefully for the benefit of the wider investing community. But what I like to do is I like to present my new theories or new ideas that I have to these students who are quite fresh. Mm-hmm. And I feel that I get more actionable feedback from the question and answer sessions during these presentations than I can get in weeks or even months of research or my own reading. They ask really thought-provoking questions. And to me, that just serves to highlight the wisdom of that John Whitehead quote. So, he was a senior partner at Goldman Sachs, and he wrote a book called A Life in Leadership, when he said, you really don't know anything until you help someone else to trying to understand it.
I think it's brilliant. And the way I look at it, I love writing. It helps me organize my thoughts. There's one thing to have an idea and to actually write it down, explain it to somebody. As you know, I manage money for families, stock portfolios for them, long-term patient capital. And I really appreciate the questions that they ask, because some things I do, but to actually explain why I did it. And when they ask questions, we go a layer deeper. And then at the end of the week, I usually write something. Sometimes I publish it. Sometimes I just share it with the client. Sometimes I share it with the general public. But that loop of doing something, explaining why you did it, have people ask questions why you're doing it and explaining it again, the learning that comes from it, and then the respect that I continue to grow for the fact that I'm managing somebody else's lifetime of savings or an inheritance. I think it's a wonderful thing and an aspect of investing that's not talked about enough, that it's this interaction. And the students you talk about, and I had interns over the years, if somebody has very little exposure to investing, the questions they ask can be incredibly valuable because they're not biased or prepared, and then they can ask a question from a completely different angle. And speaking of different angles, I have to bring up a painting that was an inspiration for the title of your book and the whole theme around your book, Perceptive Investing. Can you talk about the Magritte's painting? What does it represent and how it inspired you to take that kind of framework for the book?
I'm really glad that the painting resonates with you, Bogomil, but I had a feeling that it would, given that I know that you're a lover of the arts and that your wife plays the harp. So I guess I found that the saying that a picture can be worth 1,000 words is almost always true, but it's even more true when we're trying to explain something that's a complex topic like successful investing. And this image is actually on the first slide of the partnership presentation that any investor gets if they want to meet me, because I think it perfectly captures the essence of what we believe is successful investing. And the reason that you've kind of alluded to in your question there is that the painting by René Magritte, so it's called Clairvoyance, which informally could be known as perception. And what it does is it shows the skill that we believe separates my firm, Loh-Gronager Partners, from all the other investment firms out there, and indeed successful investors from the rest. And that is perception. So for the benefit of anyone in the audience, I appreciate I haven't got a copy of the painting on my wall behind, but now would be a very helpful time to have it. So for anyone that's unfamiliar with the painting, I'll just describe it briefly. So in the painting, the artist is pictured seated in a chair, and he has the canvas on an easel in front of him. And on the left-hand side of his body is a table with an egg on his left. And the artist is looking at the egg. But on the canvas in front of him, he's painting a fully grown bird in flight. So for many people, as it was for me when I first saw it, at first glance, the painting, like almost everything in the investing process, appears fairly simple. However, that simplicity is very deceptive, because the closer you look, the more complex the subject matter becomes. Investing is a zero-sum game. Success comes from seeing things that others don't, whether that's correctly identifying an enduring moat around a business or recognizing the growth opportunities open to a company which haven't been discounted in the share price yet. And the ability to correctly predict the future price of something, which relies only on current and past information, really is the hallmark of a successful investor. And what I find is that most investors are first-level thinkers, especially when they begin. So when presented with an egg in this example, as in the painting, they treat it as an egg. But like the artist, it takes a particular focus and insight to be able to study the egg and see through it to the fully grown bird in flight. And that to me is second-level thinking. So for me, perceptive investing is the ability to review all of the incomplete data sets available in the market, and then through intense focus and insight, being able to project forward a different outcome from that's priced in by the market. Mm-hmm. And I think this comes neatly onto the subtitle of the book, which is the difference between art and science. So the subtitle to the Perceptive Investor is the art and science and temperament of successful value investing. So for me, the art part is the intangibles. It's the qualitative analysis of business. How do we evaluate the soft factors of a business, like its culture or its competitive advantage or its business strategy? And then the science part of investing is perhaps the more straightforward part, which is the raw numbers, the ratios, the valuation metrics that go into a quantitative analysis of the business. And I think that the best way to describe perceptive investing and the interplay of art and science is this painting by René Magritte. And then I think I normally take it one step further, which is I give an investment example, which I'm happy to share with you, which I think demonstrates that power of perception when it actually comes to investing. So I like to take the example of Amazon, which IPO'd for $18 back in 1997. And I'd like to pose a question to the people that I'm presenting to. And I usually ask, what evidence was there in the prospectus or the company's past behavior that would have led you to have invested in it? What would you have been looking for? And then I say, take it a step further. If you had invested at the IPO price, what would have made you buy, sell, or hold when the stock went up by a factor of 5 within 2 years just before the dot-com bust? And then I say, and if you hadn't invested at the IPO, what might lead you to have invested after the bust when the price tanked 95% back to below the IPO price? Because the fact is that at any point in time, if you understood the science of investing, the numbers behind the business, the Amazon financial information, showed that the business was on an increasingly strong trajectory. So there was enough data there to show you the remarkable feats of financial performance that Amazon had previously achieved and was achieving. And then mastery of the art of investing came from being able to see through the numbers to the incredible culture that the management team was building there, the scale economy shared business model that Amazon was evolving. Because Amazon was clearly an exceptional business from both an art and a science perspective, regardless of the volatility of the share price. And one of the things I always like to give at the end is, an aside that if you'd put $10,000 into Amazon at the IPO, it'd be over $12 million today. And everyone goes, well, that's fine. But, even if you had bought at the dot-com peak, it would still be a 50 bagger today. So that's a 23% compounded annual rate of return. So there's a valuable lesson there for investors that, exceptional businesses with very long runways, even if they become temporarily overvalued, they can offer plenty of additional growth opportunity along the way. And I think it sounds so simple. And it looks so simple, just like the painting. But like most things in life and in investing, the difficulty lies in being able to correctly perceive a reality that's different to that of the market. And that's why the title of my book is The Perceptive Investor, which is also a tribute to the father of value investing, Benjamin Graham's own seminal work, The Intelligent Investor. And that's the book that Buffett said is the single most important book about investing ever written.
You touched on so many fascinating things, and I wrote down a couple of things I want to come back to. I'll start with a little reminder for the audience that any stock we mention, it's not an investment advice, it's a case study for you to explore. But I want to mention a very memorable letter that Bezos wrote when the stock went down from, I think, 107 to $7 or so. So it lost
exactly.
$100. That's 98% or whatever it is. And the first word of that letter, the audience can look it up, was ouch.
Yes, I remember this one well.
So I just want to mention that sometimes the ride, the journey can be very, very uncomfortable. But that's one fascinating thing. The other aspect, and I want to bridge it with the book and the painting. Like Clairvoyance, you could understand it as looking into the future, right? You're trying to see what's coming. And I want to bring up, I had Sam McLemore on the show, who worked with Bill Miller for 20 years. Bill Miller, you mentioned him in the book as well. And she shared with me a story that is part of the podcast. The audience can look it up when it comes out. And she mentions how they were at an annual investor meeting, some company shareholder meeting. And they were looking at the filings, and somebody was asking questions about the future, that he knows what the future will be, or speculating about the future. And Bill Miller asked him, where is it in the filing? Because the filing is all about the past. The filing, it's all about the past. All we look at is the past. And I want to bring up a quote from your book, from Ian E. Wilson, that the knowledge is about the past and all your decisions are about the future. And it's such a powerful statement. And it's the essence of your book. We're looking at the past and we're trying to figure out the most likely future, the one we want and the one we don't want. The one we don't want, I don't put it in the portfolio. But I'm oversimplifying something much more complex. But can you talk about that beautiful bridge between understanding the past, looking into the future? And can you tie it back to the idea that I shared on this podcast, that anybody can buy a stock, but very few people can actually hold it, especially over a long period of time, which is something you write a book about it in your book, the execution, actually holding of the investment over a long period of time.
Yes. So I really, that Ian Wilson quote, so he was a former chairman of General Electric. And I think that brings us quite neatly into the concept of circle of competence, and investing with a margin of safety. Because it's only through understanding our own circle of competence that we can learn how to establish a margin of safety so that we can understand what we know about the past and therefore have the confidence in our perception of the future. When we were discussing in the beginning where I said, I think that you and I here today and all the members of the audience listening in, we're a sum total of all of our prior experiences. And I believe that very much is the case in investing, where our circle of competence is essentially the sum of all the knowledge that we've accumulated over the course of our lifetime. And we remind ourselves of that at my investment partnership. We draw on the wisdom of Charlie Munger when he said, the investment business, all knowledge is cumulative. And the boundaries of an investor's circle of competence are therefore always changing because they're always learning and experiencing more. Therefore, in the investment business, experience counts, whether it's positive or negative. So, if we want to talk about growing your circle of competence, there's really one very simple course of action, and that's to read. I think Buffett famously said of Munger, he's like a book with legs. You'd be amazed how much he reads and how much Warren also reads. So in my experience, the most successful investors have always had a strong intellectual curiosity about business and why things work the way they do. They have a thirst for knowledge and they can't help but ask questions. And I think it's, the information that they glean from reading newspapers, trade and industry journals, or books, or attending investor conferences, and they put them through their investment filters, and that helps to develop their investment process over time and sort of refine it, not only in relation to idea generation, but also building muscle memory for when it comes to evaluating or analyzing a new investment idea. Because when it comes to risking your own capital, really should only invest in things that you truly understand. And that is what builds a margin of safety, meaning that if you're wrong, you're not going to lose all your capital because you understand the value of the business. And I think a good example of that is one that Buffett has given many, many times, which is when he bought his stake in the Washington Post newspaper, and he still owns it, 40 years later. And he gives it in the example of the super investors of Graham and Doddsville, that very famous speech where he refutes the efficient market hypothesis. And he says, the whole company was valued at 80 million when he bought it, but actually all of the assets of the business were worth 400. So, that's an example of what a real margin of safety is. And, it's not factoring in any growth. And he famously said, when it comes to margin of safety, rule number 1 is don't lose money. And rule number 2, don't forget rule number 1. It sounds simple, but it's in the execution that it's difficult. And I think a lot of investors get, especially when they're starting off, they're very preoccupied with their circle and making it bigger. But its breadth and depth will expand over time through constant learning and looking at new investment opportunities. And I think that in their early years, investors focus too much on expanding their circle rather than focusing on establishing firmly where the boundaries to it are, because that's what leads them into trouble when they stray outside of that. So I think it's also important to remember that you don't have to have an opinion on everything. It is okay just to be an observer. It's perfectly acceptable to pass on a stock or a sector if you don't have an opinion or you're not comfortable with it. And actually, that should really be an essential part of your investment philosophy, because it will help you narrow down the universe of investable securities. For us as a global equity manager, there's 45,000 listed equities globally. So for me, it's definitely okay to say I don't know. And more than half of the businesses I look at almost immediately end up in my too hard pile, because succeeding as an investor doesn't depend on how much you know. It depends on whether what you know is right or wrong. And one of the things Warren has said at the Berkshire AGM a few times is, we don't get paid for activity, just for being right. So this comes back to the final part of the question you asked, which is the holding. And patience for that is absolutely key. But before that, you have to make sure you're operating within your circle of competence, and therefore you're buying with a margin of safety, because that increases the likelihood that you're going to be more right than you are wrong. And that gives you the confidence to continue to hold.
I love what I'm hearing. I want to dive in on a couple of things. One of the last things you mentioned, which really strikes me, and I find it fascinating, that we might acquire knowledge and understanding of a business that we may still not act on it. In the last 20 years of investing money and interacting with a lot of investors, I came across people that would, and I catch myself do that too. I could do all the research and understanding and everything else, but then actually acting on it, it's as important. You brought up Amazon as a case study, and I'll bring up Buffett again, but Buffett mentioned Bezos many, many times over the years at the annual meeting. Public record, people can look it up. But he never acted on it, right? Even somebody we look up to. I think as close as he has ever gotten, and somebody can confirm it, he owned some bonds that were heavily discounted 20 some years ago after the internet bubble burst. They might have been issued in Europe. Somebody covered it in an article. I don't remember the details, but that's as close as he has ever gotten to owning anything Amazon related. So it's fascinating that it's not just the knowledge, but once you have the knowledge, earning in a way that kind of confidence, conviction to act on it. And you mentioned in the book, I think it's very, very important. And once you do act on it, hold on to it. When you mentioned curiosity, I hear understanding. You said understanding, right? So I think what I'm trying to do, what you're trying to do, and what Buffett and Munger have tried to do is just trying to understand each individual business, the world as a whole, human behavior. I'm just trying to understand. It's like this open-ended pursuit of every day I feel like I understand a little bit better. And then I get surprised, and then I understand better. One last thing on the topic. When I see the circle of competence, and somebody pointed it out to me, if you see a circle in the boundary, the more you know, the area around it gets bigger and bigger. So you realize, well, I thought I know a lot, but now I know how much I don't know, right? So you start touching a lot of topics and areas. And as investors, we all evolve. The businesses that Buffett owned in 1955 are very, very different that he owns in 2025. We all grow and change, and I have changed in the last 20-some years of doing it, and I'm sure I'm going to change in the following 20 years. But it's a never-ending expansion and maybe a replacement of knowledge that's useful, knowledge that's less useful. I want to ask you about the checklist. You casually mentioned in the book that you have a 250 question investment checklist. And I'm not going to ask you to list all of them, but I would love to ask you which ones you think would be the most eye-opening, surprising, and maybe the most helpful for this audience. One or two, whichever ones you want to pick, that you feel like they made a huge difference in your process.
Yeah. So it's interesting because I think to answer that question, I'll give you a little bit more background about our checklist. And then you'll see, because the answer to that question is all of the checklist is the value it adds versus any individual question. So one of the things my investors say when I say we've got, 250 question investment checklist, they usually look surprised and they say, why have you got a checklist? And then they ask, isn't 250 questions quite a lot?
It is.
So as to why we've got a checklist, it's not a new concept. As you know, Bogomil, that, it's used in lots of different industries, whether it's pilots flying airplanes or surgeons operating in a hospital. And the purpose of a checklist is to make up for our fallibility as human beings and falling prey to our own cognitive and behavioral biases. And I think that point links quite nicely to what you said just before when you were commenting on my answer to the previous question, which is it's the search for truth. That's what investing is. It's the search for truth through knowledge, the acquisition of knowledge, constantly questioning. And it's the humility that comes with that to know that we're often wrong and being able to learn from that. And that's what the checklist is designed to highlight. So, our investment checklist at Loh-Gronager Partners, it's dynamic. So when I say it's 250 questions, it can sometimes be a few more, it can sometimes be a few less. The wording can change. And it essentially changes because we think that we need to focus on evolving our investment process as markets evolve over time. It shouldn't remain fixed. But broadly speaking, it's divided into two sections. On the one side, you've got the quantitative analysis. On the other side, you've got the qualitative analysis. So, quantitative being a deep dive into the numbers behind the business. So that's through the financial statements. So a question would be, for example, what is the 5-year rolling trend on return on invested capital for this business? And then on the qualitative side, these are areas that are a lot more subjective. So a question there might be, are the management team good capital allocators? So I should say at the beginning, though, that, preface it that we don't set out to complete the checklist with every business getting a perfect score, nor do I think that actually it's possible for any business to get a perfect score on the checklist, because that's not its purpose. It's designed to flag areas of potential concern for us that might require a little bit more research. And what we found is that what the checklist does, it forces us to look at all of the aspects of the business as objectively as possible. And very importantly, it's done in a particular order, as the order in which our brains receive information and process it can actually be a very important determinant of the conclusions that we come to. So it's really to help us to form an unbiased as possible investment decision, recognizing that we're all fallible. And I think there are two components of our checklist I think you'll find maybe unusual or interesting. So the first is what I call the centering exercise. And this is at the very beginning of the checklist. So whenever I'm completing the checklist for a current holding that we own or a potentially new one, I actually have to answer 10 questions about how I'm feeling. before I start the work. Because if I'm feeling angry or stressed or tired, I know that the best time to be doing my investment research is certainly not during that period of time, because my mood will color the analysis, and that's just human nature. And there's a lot of studies on this. The famous one is by Dr. Schubenstein, and he basically showed through his studies that hunger, anger, loneliness, tiredness, pain, stress, all of those emotional strains that you can feel, they're all common predictors for poor decision making. So once we recognize those creeping influence of any of those emotions into our investment process, we should take a break, we should recalibrate, we've got to make sure we're doing this at a level emotional state, because we can only continue with the investment process after our emotional balance has been fully restored. Because the ability to make mindful decisions is a key component of having the right temperament of successful investing. And I think the second component I think you'll find interesting is that we've compiled what we think is quite a comprehensive list of what we identify as the most common red flags about a business. And these generally also fall into two categories. So you've got financial statement related on the one hand, and that would be an example would be like earnings smoothing from one period to the next in the financial statements. And the other would be business practices related. So that might be how the business operates its inventory management.
Mm-hmm.
And these red flags can be identified as part of the quantitative analysis or sometimes in the qualitative analysis of a business. So I'm a really strong advocate for using a comprehensive checklist because I think investing, as I said in the beginning, it is an incredibly complex, if not the most complex of intellectual pursuits, because it incorporates all of the worldly knowledge on all subjects, everything around us. And I think therefore slow thinking is an essential part of investing success. So one of my favorite books on this subject is Daniel Kahneman's Thinking Fast and Slow. Because we need to guard ourselves from making decisions from all the things that can impact our judgment. So that's things like loss aversion, which makes us feel like we should be more active on days when the market and our portfolio is up, in contrast to being less active on days when the markets are down.
Mm-hmm.
And in my experience, and this is the real value of the checklist, if you ask me to sum up why would I have one, it's exactly that. Having a pre-investment checklist as part of your investment process forces you to think slowly and not fall prey to that tendency of fast decision making or shortcuts that inevitably result over time in poorer outcomes.
Are you a pilot?
I would love to learn to fly one day.
Because you speak like a pilot, and I fly planes, and I have to add...
Fantastic. So you must know Atul Gawande's book, the Checklist Manifesto.
I do, and I never took off a plane without going through a checklist. And never. I met so many value investors who are pilots, private pilots, just for pleasure. And it's remarkable how the two pursuits can teach you something, and how you say you're a better investor because you're a businessman, but I think can be a better pilot because you're an investor, and you can become a better investor because you're a pilot. It's a highly demanding activity. And there are moments when it's basically a life or death moment, right? And you're managing risks, and you ask this very, very important question. You ask yourself, how do you feel? You know that pilots are supposed to ask themselves on that morning when they schedule the flight weeks ahead, how do you feel today? Do you feel up for it? And it's such an important question, not just flying, but making any substantial decision in your life, including portfolio management and buying or selling or whatever else you're doing with your money or other people's money. So it's fascinating. I have this aspiration of being the least wrong, and the checklist that I allow me to make sure that I can be the least wrong. I don't want to miss anything. And even flying, some things become second nature, and I can close my eyes. With my eyes closed, I can find everything that I need to turn on, turn off, and then. But that's not enough. I still don't trust myself that in that moment, for some reason, I'm going to skip something that's very important, right? That's why you go through the checklist. And I think with investing, even if it becomes your second nature, and you kind of have an idea what this business is about, and you know what this management will do and everything, still go down the list.
No shortcuts.
No shortcuts. Because in flying and in investing, it just takes one thing to completely derail what you're trying to do. So, and sometimes it might feel like not that important, but just go down the list and check it off that you looked at it. And
I'm sure there's a specific order also, Bogomil, that you do your pre-flight checks in as well.
Yes.
And there's a reason for that.
And it's been tested, it's been practiced, and there is a reason for it. For every single aspect of it, there's a reason for it, and there's a lot of accumulated. You talked about accumulating wisdom, but I see the checklist as this distilled knowledge, right? I'm looking at it for a reason. It's not just that I want to fill up my afternoon with doing something. No, there's a reason why I'm looking at the debt. and I'm looking at how it's structured. I'm looking at all the different bonds they issued. I'm looking at their maturities. I'm doing it for a reason. Like everything has a reason. So I love that reference, and using checklists and 250. I love it. And maybe one day I get to see some of those questions. I'd love to see them.
Of course.
I want to ask you about something that we talked about before, and I think it brings us back to another point that I wanted to highlight. Investing can be a very lonely pursuit in many ways. You're alone on your own with your thoughts. That's one thing. But in many situations, it's not something you can do as a committee. Peter Lynch had this beautiful quote that no symphony was written by a committee and no portfolio should be managed by a committee. I'm paraphrasing with something along those lines. And I thought it's so true. And there are moments when you have to be comfortable with everybody else telling you that you're wrong. And I want to tie it back to your childhood. If I'm onto something here, that you moved from a school to a school, and I moved around and I studied in many different countries. In some rooms, I was the only foreigner in the room. In Paris at school, I was elected to a student board, and I was the only non-French student speaking up. And then I was in New York, and I was sitting at a table pitching a stock, and I was the only non-US born analyst pitching a stock. So I've been in rooms where I felt like I couldn't be more alone. But at the same time, I brought a perspective that nobody else could provide. Can you talk about the experience?
Absolutely. And, I think that you and I have a parallel there in terms of our upbringing. And, coming back to your first question, which was, I think fundamentally our early experiences in life are the core of who we are as people in the future. And I think that those early outsider experiences, Bogomil, don't want to presuppose too much on you, have definitely had an outsized impact in who you are and what you contribute compared to everybody else in the environments that you currently find yourself. Because, not everybody travels, not everybody moves. And I think that those formative experiences as a child being an outsider, it makes you curious because you see so much change, so many differences. And it also makes you comfortable with being, or at least comfortable on occasion with knowing you're the odd person out in a room, but being totally fine with that and having an opinion that's not the same as the norm. And that's what being a contrarian is. And the reality is you cannot outperform the market unless you're a contrarian.
Yes.
Because to beat the market, you have to be doing something different from every other investor. So you have to be a contrarian. And David Swenson actually gives, so he was the previous CIO of the Yale University Endowment, and he gives, one of my most memorable quotes on it when he said, and I'm paraphrasing, but he said something like, investment success requires sticking with positions that make you uncomfortable by their variance with the popular opinion.
Yes.
And that in its essence is the willingness to be lonely, and I think it's interesting because I've done a bit of research on this just in terms of my own reading on human beings. We are conditioned to be social creatures. We are herd animals. And that biological imperative means that we're driven to survive as a group. And one lesson that we've learned is that it's much easier to survive when we're in a group than when we're outside of it. So it's little wonder then that when stocks are falling, the average investor follows everybody else in the tribe and sells stocks. But what the members of the tribe can't see is that if they were willing to be lonely, this might actually be the perfect time to be buying the stocks. And there's something that we like to repeat at my firm, Loh-Gronager Partners, where we say, the stock market is the only market in the world that when it goes on sale, everyone runs away. And I think that's a really, it's a really interesting analogy, isn't it though? Because, if anyone ever said, the prices have been slashed, you automatically think there's a bargain.
Mm-hmm.
So the influence of the crowd really has a strong hold on most inexperienced investors, whereas very experienced investors like Munger and Buffett, they're entirely unemotional when it comes to stock selection and decision making. And I think one of the criticisms for this and one of the reasons why this happens is because we're all taught in high school and in university, if you take a course on economics, about the efficient markets hypothesis.
Right.
And that basically says that the current share price incorporates all of the available information about a stock. So actually, there's no point in buying or selling it. It's entirely efficient. But the main criticism of the efficient markets hypothesis, which is so obvious, is that it doesn't include human emotion. And human beings are not objective. We're not rational. And that's been proven time and time again. Rising prices, they induce greed and overconfidence and euphoria. And then on the converse side, falling prices, they introduce fear, panic, and depression. So speculators buy when the price rises, and then they sell when it falls, regardless of the fundamentals of the underlying business. And that's where value investing comes in. And people like Munger, they're entirely immune, to the vicissitudes of the market and the emotions that are caused by rising or falling share prices. And that's why I think, Buffett said famously, be greedy when others are fearful, and then fearful when others are greedy. And it sounds again simple, but it's the execution that's complex, because the willingness to be lonely and get comfortable, that comes from a core sense of identity that I think all the great investors possess. They have the courage to take a position, and they know from their experience in having a robust investment process that the worst of times in markets in terms of price performance are usually the best of times and opportunities to hoover up underpriced stocks. That's what a contrarian mindset is, and that's what I think sets apart real investors from speculators, because true investors are able to separate themselves from the herd. And that's whether it's physically, so that's like Buffett, who lives in Omaha, Nebraska instead of downtown New York, or away from the hustle and bustle of Wall Street, or emotionally creating distance between yourself and the opinions and judgments of others. So an example there might be, you don't discuss your current holdings in public. That would be an example of trying to get some emotional distance from the crowd, or you don't read Wall Street research. And I think it's being comfortable with this relative isolation where, most investors, they crave the warmth of the crowd, and successful investors are content to be lonely. And, I guess I always like to try and give examples when I talk about these things. My best personal example of this, of contrarian investing, was actually when we launched our global fund back in 2022. So as I'm sure you'll remember well, 2022 was a bear market in equities. They'd fallen more than 20%, pretty much all markets, and the media was like pre-announcing an impending recession.
Of course.
So some of the investors that we were in discussions with about investing in our fund at the time, they were put off by the market volatility. They saw central banks raise interest rates from pretty much 0 up to 5 or 6%, and they thought, we need to take a pause here. But we're contrarian value investors, and we know that the best of times for long-term returns are almost always found in the worst of times for short-term returns. So we actually decided to launch our global fund with no external investors, with just $8 million, which was provided by myself and the management team, because we had the courage of our convictions that we had a robust investment process, and now as value investors was the time to act. And needless to say, once we showed some strong performance afterwards, those investors that were initially skeptical, they wish they'd invested. But I think there's also a life lesson there, which is, markets are 20/20 in hindsight, and we've always got to be aware of that hindsight bias.
I think we're wired differently, those of us that are value contrarian investors. I think that's the essence of it. And the way I would describe it, there were moments when I would recommend a stock and everybody around the table years ago would agree with me. And a lot of people would feel like, oh, this is great. And I actually had the opposite feeling. If everybody agrees with me,
But you're the consensus.
I haven't found anything that's different. And in investing, you have to find something that's different, unless you just want to coast with, the consensus. And there were moments where nobody would agree with me, and I would walk away with the biggest smile, thinking I might be still wrong, but I found something that people feel uncomfortable with, or they have a very strong opinion about that's different than mine. And I found something. I might still be wrong, no question about it, but I found something. So I think in that sense, we're wired differently. I want to bring up something that's in your book. It's a quote from Nigel Nicholson, and he talks about how you can take the person out of the Stone Age, but not the Stone Age out of the person. And then you mention how the New York Stock Exchange is only 10 generations old. I manage money for families, and many of the families I've worked with over the years had their wealth for 4 or 5 or more generations. And one of the families I had the pleasure of knowing at some point created the initial capital when Beethoven was writing his symphonies. So it's a long, long history that overlaps with the history of the New York Stock Exchange in some ways. So I was thinking 10 generations. That's really nothing in terms of our history as a species. And we're expected to interact with this relatively new invention in a new way that most of us just can't handle. And I think that's where the opportunity lies for those of us that are wired differently. But also that's where the demise is hiding for those that try to play with the market, with the rules that would have helped them in the Stone Age, but can get them in trouble in this era. So I find it fascinating. Speaking of 10 generations, you describe investing as a never-ending game. And I love the word infinite and infinite games. And I'm curious if you're familiar with James Cars and his infinite game idea. We can talk more about it, but I see investing as an infinite pursuit, especially when you're managing money for families. There's no end to it. It's an open-ended pursuit. They have an unlimited time. They already have the capital. They're in no rush. It's a dream client for me when I think about it. They can wait. But talk to me about investing as this never-ending game. How do you see that?
So correct. I think one of my favorite aspects of investing is the fact that it is a never-ending game.
Mm-hmm.
And I think what that immediately brings into my mind is then the concept of ergodicity,
Mm-hmm.
where in simple terms, you want to play as many of the potentially infinite number of outcomes of your investment approach to be positive outcomes. And I think the same approach goes for life itself. We can view, the range of outcomes from where we sit today as infinite, but in the concept of ergodicity, we want all of them to skew towards the positive. So that would imply that we don't want to do anything that would risk taking us out of the game. So that might be, in the terms of investing, that might be say that, leveraging yourself 10 to 1 is probably not a good strategy, because ergodicity would say that the majority of the outcomes will not be great. And yes, okay, a few of them will be exceptionally good, but we would err on the side of caution on those. So in an infinite game, you can never truly win. In the game of investing, the world is constantly changing, and therefore the game and the rules are constantly evolving, as you've alluded to there in your question. So as an investor then, no matter what the scoreboard says today for you, there's always room for improvement. And I believe that you can only improve by embracing your mistakes. And that comes with a spirit of intellectual honesty and what we've talked about a couple of times now in our talk, which is continuous learning. So, in terms of performance, the rewards for doing that are really significant, because investing is the opposite of what's done in most other careers, what successful investing is. Because in most other careers, people seek to bury their mistakes. As the old saying goes, success has many fathers, but failure is like an orphan.
Mm-hmm.
But in investing, it's the opposite. And I think what we want to try and approach is the degree of intellectual honesty that we find in academia. And that's where we have peer-reviewed literature. So that's where, there's a previously accepted scientific understanding, and it's questioned by the peer group, it's tested, and sometimes the hypothesis is disproved. And those are treated as breakthroughs, and they're actually celebrated as progress by the community. And it brings to mind the quote from Munger where he said, any year that goes by where you don't destroy one of your best loved ideas is a year wasted, because it's intellectual honesty in its purest form. And that's a refreshing approach to, error correction that I think we could all embrace. I think from a life perspective, intellectual honesty also includes your own personal integrity in how you conduct yourself and how you deal with others. So I like to think of Buffett's newspaper test. How would you feel if the details of what you're thinking about doing are published on the front page of a national newspaper for everybody to see? If you approach, key decisions in life with those terms or frame it that way, you might feel slightly uneasy, in which case you wouldn't do it. Because as the saying goes, it takes a lifetime to build a reputation and it only takes a couple of minutes to destroy it.
Yes.
And with that knowledge, and going back to the ergodicity example, we always want to play and stay in the game.
Mm-hmm.
So I'd say, I think it's important to make sure you surround yourself with people you like and admire and who make you a better person. And if there's ever any doubt, you should be cutting them loose, because life is definitely too short to be dragged down by people that lack integrity.
You're touching on so many fascinating ideas, and I'll just mention the reason why I like the idea of an infinite game. I feel like in our life, we're so used to finite games where there's a winner and a loser. Presidential elections, most games we play, sports. But then there are games in life that James Carse, in his book, for the audience, if they are curious to explore, he talks about friendship. Friendship is not a game to win or lose. It's an experience you want to perpetuate. And so is marriage. And investing is the same when you really look at it. Yes, they make us believe that there's the best manager of the month and the worst manager of the year. But that's not it. You're missing the picture. What you're trying to do is deploy capital in a productive way over a long period of time. And it's easier to identify what it would mean to lose, which would be losing all of the capital that was there. That's a total loss, like the skier that Luca Delana talks about that breaks a leg and can't participate in any other race. That's you're out of the game. Once you realize what you don't want, it becomes so much more clear what you do want from the experience. And I notice that either it clicks and people get it, or they need a minute to embrace the concept.
You get it or you don't get it, yeah.
Right.
Because it's quite an esoteric concept.
It is.
It's a second level thinking concept for sure.
Very much so. Speaking of that, I want to ask you about risk. And risk is such a loaded concept. And you have quotes from Howard Marks. You talk about how when the price drops down, the asset or the stock actually becomes less risky. So that's one dimension I want to explore when people look at the stock that hasn't moved in 2 years and they say that's not risky. And then the one that just collapsed 70% and they say, oh, it's more risky. It actually is not, which is a contrarian thought I want you to explore. And the other one is, there's the probability of a risk, unwanted outcome. And then there's the magnitude. And I feel like we have to talk about the magnitude of the risk. Just the fact that you lost money on that investment, it says nothing. I want to know how much you lost, right? If you lost 5% and it's a 1% position in your portfolio, move on. But if it's a quarter of your portfolio and you lost 50%, it's a whole different experience. Can you talk about this de-risking as the price goes down, and then the probability and the magnitude of the risk that you're willing to underwrite?
Absolutely. That Howard Marks quote is really correct when it says, that negative opinions can reduce risk by driving all the optimism basically out of a price.
Mm-hmm.
And that can only happen because most investors think that quality as opposed to price is the key determinant of whether something is risky or not.
Mm-hmm.
But high quality assets can be risky and low quality assets can be safe. Marx just says that what matters is the price that you pay for them. So elevated popular opinion then isn't just a source of low potential return, it's actually a source of higher risk. So since we never know exactly what will happen tomorrow, it's easy for us to assume that the future will resemble the present, and to accept that it may bring some, other than to accept that it might bring some unknown change. So therefore, there's a bias towards sort of intellectual laziness, as I'd call it, just extrapolating the present all the way out indefinitely into the future. So a stock that's been going nowhere for a while, that might seem to be a better stock than one that's basically been falling. And as your example there in the question shows, actually the inverse can very much be the case. Because we assume that a falling price signifies that that a rising price signifies that a company is doing really well, and a falling stock price signifies that it's doing badly. But they are fundamentally disconnected from the underlying business. It's just the price. So I think the consequences of this are easy to see in the markets, where stocks with optimistic forecasts, they always seem to go higher, whereas stocks with disappointing forecasts tend to drop to new lows. And that can happen for an extended period of time. But this is the point where Marx talks about where regression to the mean comes into play, because the value investors buying the undervalued securities and while others are selling, and that can push the price back up over time. So unlike the market itself, the outcome is entirely predictable because of human behavior. So inevitably, for a business that's only got higher and higher earnings forecasts, inevitably at some point it will disappoint. And that hot stock no longer meeting the euphoric expectations of Wall Street, that can make the uneducated investors all rush for the exits, and that depresses the price. And ironically, that depressing of the price might bring it back into the value investors' remit as being less risky. Because financial markets are auction driven. Investors constantly outbid each other for the quantity of a particular security available on sale. And it's the highest bidder that always receives the allocation. And you see the effects of that in every bubble in stock market history. So I think it's always worthwhile to remember that, as Graham said, Mr. Market or the market itself, it's there to serve you. It's not there to be your master. So it pays to ignore the random price movements. And I think that having a strategy that allows you to take advantage of the difference between true and perceived risk is incredibly important. So then to the second part of your question, which is talking about the risk versus the magnitude of that risk. In my investing experience, the investment situations that offer the most asymmetric risk reward, so the best balance between risk and reward, are those where the market is confused between risk and uncertainty. So as value investors, we define risk as the probability of a permanent loss of our capital, but that's very distinct from price volatility, which is almost entirely made up of random noise. Markets, however, view price volatility as risk. So therefore there is uncertainty. If there's uncertainty around a business, the price action can become very erratic, as there's nothing that Mr. Market, in inverted commas, likes more than uncertainty. And it's in these situations that we as value investors who are patient and methodical and impartial can extract enormous value by identifying that there is less risk in a situation than the market price is currently reflecting. So, at my investment partnership, we're concentrated long-only value investors. And so our maximum risk is that a stock goes to zero. Now, that risk can obviously be significantly mitigated if the business is profitable, if it's unlevered, if we're buying it at a low price to its intrinsic value. That said, our worst case downside scenario is that we lose 100% of our money. But conversely, our upside is unlimited, i.e. there is an asymmetry between the potential risk and the potential return. So for us, our risk as long-term value investors is that we don't fully capture the upside of a business that we own by selling it too early. And that's again where patience comes into play, as it's an absolute necessity in every part of our investment decision-making process.
I often say that I might not be smarter than anybody else. I might not be faster than anybody else, but I definitely aspire to be more patient than most, because that's where I really have control over the outcome, that I can wait, and I can wait to buy, and I can wait to see the full outcome. And it's fascinating. There are those studies. Chris Mayer did a lot of work on the 100x companies. But the one part I really thought about is that the time it took to get to the 10x or 50x or 100x, it took time. And you mentioned Amazon buying it at IPO, waiting for the massive drop during the internet bubble burst, but just waiting and holding through that period. It's very, very hard. And that's where...
It's so interesting that you mentioned that, Chris Meyer, because I actually have a printed version of the graph he has on there, where the x-axis is the compounding rate and the y-axis is the number of years. And it just shows you that even at a 20% annualized compounding rate, you're still talking about well over a decade for a business to be a 100-bagger. And when the attention span of markets is now measured in months, you just know that it's almost impossible for most investors to ever realize these returns.
And I think it's Howard Marks who also gave this example of somebody that buys a stock at 10, sells it at 11, buys it at 15, sells it at 16, buys it at 20 or 21. And he says, this person was right. I'm paraphrasing what he says, but it's basically speculating and capturing a very small movement. But then somebody that bought it at 10 and held it all the way to 30. That's the person that made the most money.
Yes.
They're both kind of right. They're right. One was just in and out, in and out, in and out. And the other one just held it. And I'm not saying it was a straight line. In most cases, actually, it's dropped to 7, back to 12, and on and on and on. But holding it from 10 all the way to 30, that's how you make money. And it takes time, as you said. It could be a decade. In my clients' portfolios, I know some of the holdings have been around for more than 10 years. And it's remarkable. And I love seeing it. And I love seeing the low cost basis because of how long those stocks have been there. And if they have a reason to stay, they stay. But having that ability to hold those stocks for so long, which makes me think, we talked about an infinite game, and I wrote about it in a few articles, that in investing, we're dealing with finite assets. Businesses will not last forever, and it's something you bring up in your book, the longevity of the business and the life of the business. Can you talk about how you address it in the world that's changing so fast? I mean, you talked about COVID and lockdowns when you started writing the book. Even in those 5 years, I mean, we could both list 10 things that really changed in how we live, even consume entertainment, and even not just consumer behavior, but investor behavior and so on has evolved and changed. And the businesses had to adapt, respond, or even fall behind in some cases. Can you talk about that? How do you address that infinite, never-ending investment horizon with a finite asset?
It's a really interesting question, and one that I don't think anyone has a proper answer to. But I think it's a really worthwhile exercise to explore, because, at its core, how can a business have longevity? And in my mind, it comes from a combination of adaptability on the one time, and on the other side, evolvability of the business. And that has to be core to the DNA. And that manifests itself in the depth and breadth of the moat around the business. And that's how I think as value investors, we can sort of evaluate a business through the finite lens, but within an infinite game.
Mm-hmm.
The concept of economic moats, it's not a new one, but it still attracts a great deal of heated debate, mainly about how to identify them and how do you measure them, and also how do you sustain them, or how does a business sustain them over the long term. By using the term economic moat, what I'm really asking is, what's a company's competitive advantage? Mm-hmm. And is it durable, is it expandable, and is it sustainable? And I think your question hints on a really important factor of the investment process, which is once we acknowledge that every company will fail, that their corporate life is finite, I actually think it's easier then to invert the mental model of why is this a great investment to be like, why is it not a great investment? What are the frailties in the moat around the business that currently look unassailable today, but why might they be made more shallow over time? When I worked at Credit Suisse, they actually came out with a report that was looking into how do you quantitatively measure a moat. And what they found was that the most correlated ratio they could find over time was by looking at the spread between a company's return on invested capital and its cost of capital over time. That was what they found the best quantitative metric. And obviously it's incredibly flawed, but that was their research. Obviously Credit Suisse is now out of business, so maybe they should have spent more time looking at their own returns on invested capital, but we'll leave that for another day. But in my experience, though, it's the quantitative measurement doesn't capture all of the nuances that go into a business's moat. I find it better to ask a qualitative question to explore the width and depth of the moat first. And that question, you wanted a question from my checklist earlier, I can give you another one, which is, what would I need today to start a business to compete with this potential investment? So to answer that, I'll really need to have an understanding both of the industry and its competitive dynamics. Clearly, capital is going to be very important. How much money do I need to start my new business with? But it's certainly not the only thing. We also need human capital. So, how many employees do I need and how educated and what specialities they need to have? We might need patents. We might need a strong brand name. What scale do we require to effectively compete? How much market share would we need to achieve to reach that level of scalability? And once we know the answers to those questions, we can begin to quantify it by evaluating the cost of competition in terms of money, but also time and effort and energy required to do so. So this is basically a thought experiment that allows you to conceptualize the business's moat and allows you to begin to sort of quantify its size. So once we've done that, we still need to establish the durability of the moat. How long do we believe that the firm can maintain this competitive advantage? So Buffett has always said that competitive advantage is easily seen in a company's ability to raise prices in excess of inflation. So in other words, how price inelastic is demand for the firm's products. And the example he always holds up, and I actually have a can here, which is a useful prop, is Coca-Cola. So people love Coke, right? There are billions of cans consumed around the world every day. So would they still buy Coca-Cola if it went up by 1 cent per can, or even 10 cents, or even more? That's the question. Coke has incredibly high price inelasticity of demand. Even if Coke doubled its price, I doubt it would convince most people to not consume it and switch to what they see as an inferior product. So that's a durable moat. So what Buffett often says in his annual letters, which you'll have read as well, is that he often tries to focus his managers not on increasing near-term profits, but increasing the moat around their business so that every year they're making it a little bit wider and a little bit deeper. And how then can we measure the growth of that moat? So that's the final part of the question, really. For an older product like Coke, we'd want to ensure that over any 5-year rolling period, there's no impairment to the value of the brand in this example. So when I think of things that could make Coke stock go to zero, the one main thing that comes to mind is if people were to associate the Coke brand with something harmful. So by extension, then all of its products are unsafe for consumption. So in that, I think the Coke management have thought about this as well, because that's why they spend billions of dollars every year on advertising to only associate themselves with happiness and good times. So whether that's Christmas or the Olympics. So coming back to the Credit Suisse study on business moats, the authors, they had like a conclusion to it. And they basically said that, a clear understanding of how a company creates shareholder value is also core to understanding sustainable value creation. So that comes through understanding the stability of the industry in which the company operates, the total profit pool available to the company, and the business's current market share within that pool, along with its past trajectory of growth in terms of gaining additional share. And the final thing that they found, which I think is incredibly important, is culture of the firm. And that was the most referenced trait among the firms that they asked. If they asked them, what characteristic of your business would you associate with the reason why you've been successful over such a long period of time? So that led them to conclude that culture is potentially an enduring source of competitive advantage.
I love everything I'm hearing. And I was thinking of one single word, which is quality. And it's a word that's very hard to define, and people have tried to define it. I had Chris Beck on the show, who teaches the original security analysis course at Columbia. And I was lucky enough to be a guest in his class and listen in on one occasion, which was fun. And we spoke about quality, and Nick Sleep wrote about it. I'm sure you're familiar with his Nomad letters. But it's fascinating how we're searching for that something that will give us some feeling of permanence and continuous improvement around the business. And it's not just that the business will be around decades from now, but that it will be as magnificent as it is today. I think that's the challenge. And studies show that companies stay at the peak. They might be around for 100 years, but they stay at their peak in terms of improvement and growth and expansion and so on for only 2 decades or so. And to capture those 2 decades, I think it's very tricky, and not to overstay your welcome. In some cases, it's also very important. And I had Professor Aswaf Damodaran on the show, and we talked about the life cycle of a company, and he has a fascinating recent book about it, how investors go in and try to apply the same metrics to companies at a different stage of their life, and they say this is cheap, this is expensive, or this is the right management for this company or not, which was fascinating to me to see that the founder CEO might be right for the early stage of the company's success, but might not be the right person later on for various reasons. Just accepting that a company has its own life cycle. Since I brought up Chris Begg in his class, I have to talk about Ben Graham. And you talk about Ben Graham in your book. And I want to bring up something, and I wrote it down. You mentioned how he sidestepped the 1929 bubble, only to face huge losses using leverage in the following years trying to pick the bottom. And then he made most of his money, actual net worth, in a stock that's nothing like any of the stocks you would usually pick. So between those three things, sidestepping a bubble, using leverage, getting in trouble, and then making most of the money in the stock that he admits in his books was not like any of the stocks he usually picks. Can you invite this audience to understand a little bit better the Ben Graham that you know through your study and that you talk about in your book?
Absolutely. So Ben Graham, as we know, is widely viewed as the father of traditional, as I would call it, value investing. So he pioneered the strategy of having a portfolio of what he called net businesses. So those were businesses that were trading below their net asset value. And that's how he came up with the concept of margin of safety. That's one of the founding principles of value investing. And he essentially found that after he, as you said in the question, sidestepped the 1929 stock market bubble. But then he used leverage when he was trying to pick the bottom and lost 70% of his net worth from 1929 to 1932. So there's already a lesson there, which is that none of us are infallible and all of us are on a learning curve. And despite his phenomenal track record as a stock picker, when it came to buying dollar bills for 50 cents, which is essentially what net stock investing is, when he died, the majority of his net worth came from a single growth stock in his portfolio, which was GEICO, which he held for over 25 years. And that's interesting because the average portfolio holding time for his portfolio of nets was usually 3 years. So what made this so different? And I think that what this shows is that he'd stumbled upon a method that was superior to his own. And it's that method which is not buying it's buying good businesses at a reasonable price instead of reasonable businesses at a good price, as Buffett would come on to say. And that's essentially what Buffett has made famous. So in today's world where we've got easy access to financial markets, you can easily get leverage on your accounts, and you can trade anything from cattle derivatives to exotic currency pairs. I think it's more important than ever that we have a really solid grasp of the history of financial markets, and that is learning from the experiences of others. And I think it's a famous quote from George Santayana, who said, "Those who cannot remember the past are doomed to repeat it." And that's why it's so important to have the knowledge of the past to concrete the circle around the edges of our circle of competence. Because most of the biggest mistakes from the past could have been avoided if the investor in question has stayed within their circle of competence or embraced contrarianism. But as we know, it's incredibly hard to do in practice. Just think how hard it must have been for Buffett, who refused to buy tech stocks during the 90s tech boom, because he admitted it in his letters. He said, "I do not understand these businesses, and I'm not going to change my strategy from something that works, that I know works, to something that I don't understand and I don't know whether it will work." And people called him a dinosaur, and they said he was past his peak. So imagine the pressure on him at that time, and during that time also Berkshire Hathaway stock halved. And despite all of those external pressures, he refused to buy a business that was outside his circle of competence. And the key lesson that I feel for myself and for all the other value investors is that ultimately he was vindicated. So this comes through the concept of patience again. The tech boom of the 1990s turned into the incredible dot-com crash of 2000. Interestingly, in the year 2000, where most of the dot-com stocks went down 90%, Amazon was down 95%, Berkshire's stock price doubled, And the lesson here for all of us is that in investing, we have to continuously focus on refining and improving our investment process, because that's something that's within our control. But we can't control the investment outcome. So there's not any point in focusing on that. And I think that brings us back to the conversation about temperament as an investor. And it's having the cognitive flexibility that Ben Graham showed with his GEICO position. And if you want a more recent example, it's what Buffett showed us when he purchased Apple, that you need to be able to evolve your investment process with markets, but only when those businesses come to sit within your circle of competence. Buffett missed Apple the first time round in the 90s, but he was it was within his circle of competence when it came around in the 20s. And we all know that now today was, I think the largest dollar amount ever made on a single investment by an investor in markets.
Well, since you mentioned Apple, and it's no investment advice or a recommendation here, but it brings back the memory that I have of my conversation with Chris Blomstrand that writes a beautiful letter about Berkshire, and he's research every year, 100 some pages that's public. The audience can look it up, that I really enjoy reading every year. And we talked about the fact that it was a handful of investments that really made a difference at Berkshire over the last decades, more than half a century. And speaking of that handful, I want to bring up something that's also in your book. You reference Lee Freeman Shore, who tried to create a fund that was the highest conviction stocks. So he had to, I understand, some success investing, and then he thought, I'll just pick the ones that I'm the most convinced about. The outcome was the opposite. So there's a twist to that story, because sometimes the least conviction ideas perform the best. Could you talk about that? It's fascinating. We do the research, everything we talked about through the last hour or so. We find the idea, we go through our checklist, we buy the stock, we feel good about owning it because nobody else likes it. And then it might not be the one we thought will do the best. That's the one that actually pulls the portfolio forward.
I think that what the question there hints on is something that we've referenced several times, which is humility.
Mm-hmm.
You need to have humility in your investment process. And I'm really glad you brought up this example of Lee Freeman Shore's study, which I think is fascinating. So he was, as background, he was a portfolio manager at a firm called Quilter Asset Management. And he essentially oversaw, as the lead portfolio manager, a subset of he had sub-portfolio managers that each had their own individual portfolios. And what he noticed was that most of them made money on only about half of their investments. So his insight from that was, well, if the majority of the gains are skewed to the few biggest winners, and according to the portfolio managers themselves, they always knew that those stocks were going to be the big winners in their portfolio. Why wouldn't he just ask them each to nominate their best idea and put that into a portfolio of best ideas? So that's what he did. So he set up a new fund that essentially cherry-picked the best ideas from his market-beating fund managers to combine them, and he sold it to the investors as a best ideas portfolio. And they raised significant assets for this at launch, and the results were terrible. The portfolio underperformed so dramatically that it was closed within 2 years. And it's so interesting that Freeman Shore actually wrote a book about it called The Art of Execution, which it's a bit of an esoteric book, but I think it's worth the read if you find this sort of study interesting. And the main reason for its failure that he identified was that actually not one of his portfolio managers, and actually he believes that no one can know in advance which of their investments will perform best when they make them. And often it's the best ideas we have. Often it's the ideas that we have the least conviction in that can actually go on and outperform those ideas that we thought were dead certs. So another reason was that once an idea was selected by the managers, and I think this is quite interesting because this is cognitive and behavioral biases, as their best idea, they would insist on continuing to hold it. So even if the performance was poor and they changed their original investment thesis because they knew they were wrong, they totally would ignore it and they'd continue holding. And that's those cognitive and behavioral biases in play again. And why, again, it might be a good idea to not talk about your current portfolio holdings in public, because that it can lead to these cognitive and behavioral biases that can make it very hard for you to change your mind. So I think the conclusion for me then, and I think for anyone that reads that book, is that you can't pre-select your winners. And actually, the Freeman Shore takes it a step further, and he says you actually can't rank, if you've got a 20-stock portfolio, the ideas from 1 to 20 in terms of what you think the best returns will be. It's pure guesswork. So on that basis, it doesn't make any sense at all to allocate more capital to those ideas that you believe are your best ideas. Even if you have one company that you believe is the best investment you've ever come across, no doubt an example of overconfidence bias, it would be a mistake to allocate more capital than you would normally do. So to double the capital you put into it, that would be a mistake. Because position sizing in terms of the money you put to work is clearly then an essential element of not only portfolio construction, but it also determines the investment returns that you're going to make for your investors. Drawing on that experience in our fund, our global fund at Loh-Gronager Partners, I like to keep the capital allocation decision on position sizing very simple. So I favor about a 5% full position for every idea. So a 5 by 20 portfolio, you might call it. But I'm happy to have a slightly smaller starting position if I find more good ideas than I'm expecting to find. And I supplement that by the fact that we also have a portion of the portfolio allocated to what I call watch list positions. So we usually have between 5 and 10, and these are smaller positions that are 1% positions. Because what I find as an investor, and I truly believe it in the words of Lee Lu of Himalaya Capital, who famously was given capital by Charlie Munger to manage, you never truly understand a business until you own it. So when I own even a small position in a business, I'm more mentally engaged with that business. And I switch from being an observer to being a business owner. And I'm therefore far more likely to spend the requisite time to see if my watchlist companies need to be culled or need to be promoted over time to full positions in the portfolio, or 5% positions. So, to put it another way, using a sports analogy, the full portfolio positions, which are initiated at roughly 5%, that's the starting team. They're the names that we want to have out there on the floodlights, and they're the best of the best. They have a proven track record, and they're on the pitch playing the game. And my watch list, or 1% positions, those are the players that are warming up on the sidelines. They have everything going for them, and they're just waiting for the opportunity to be promoted into that first team. Mm-hmm. And I'm happy to keep a position or a company on our watch list for many years, so long as it presents the right investment characteristics, even if its price means that it's not at a sufficient enough discount to its intrinsic value to be promoted to a full position in the portfolio. And if we're on the wrong side of the estimate of intrinsic value, so again, this is humility in the investment process, I might think that a 1% position is overvalued, but actually it might be incredibly cheap when we look back in 10 years from now. But at least by having it as a 1% position in the portfolio, if it does end up being a 100 bagger that I don't have the foresight to during the next decade to upgrade to a full position, it can still have a meaningful impact on the returns of our portfolio, as it will grow from a 1% position, obviously, into the entirety of the portfolio during that period of time.
There is an element of natural selection, for lack of a better word, when it comes to the portfolio itself. If an idea is a good idea, it means that it goes up. It becomes a bigger and bigger part of the portfolio, assuming all the other positions haven't moved, right? And then if it was a bad idea, it just did not do what you expected, it becomes a smaller and smaller position. And I think even Buffett had this example that he put in the same number of billions in two investments. I think one was a US Treasury that was just paying income, and the other one was in some sort of a stock. And he made an argument that over the next 2 decades, one is still $1 billion plus the accrued interest, and the other one is a multiple of that, and maybe a larger percent of his entire portfolio. So it's fascinating when you extrapolate that over many years. And now the question that goes back to the early one, and there's no answer that one size fits all, but at some point you have to start trimming those positions and how big of a position you allow it to happen. And it's a tricky place to be in, because we talked about Howard Marks, that the price dropping kind of de-risks the investment, depending on the context, oversimplifying here. Then when the price goes up, and you pointed it out throughout this conversation, if you had 20 quarters you never missed, your stock is doing so well and nobody thinks you could ever possibly miss, wait for the first miss.
And then we'll see the result.
And we will see the result, right? I mean, it's short, it's irrelevant over 20 years, but it can be very shocking on the day you open your laptop and you see a 20% drop in a well-established liquid company, which is something we're seeing these days, a whole different phenomenon. But it's something to take into account that if it's 20% of your portfolio at that point, you're going to feel it. I think that's the point I'm trying to make. I have one big question for you, and I want to bring up the last 3 words from your book. You say, never give up. And I want to know what it means to you. And I'd love you to tie it to your definition of success, because I feel like the 3 words play nicely together with how you think about success.
I think that's a really nice question. It's also a very personal one, because I think, discussions about success are like so many things in life and in investing that we've touched on in this conversation. They're simple on first impressions, and then they're incredibly complex and multifaceted once you look beneath the surface. So to me, success is really a personal concept, and therefore any one person's definition of success will be different from anyone else's. And therefore my answer is going to be different from yours, Bogomil, which will be different from anyone else listening. So when I think about success, I think about the only resource of which, no matter who you are, we all have a finite amount of, and that is time. Mm-hmm. So for me, success means being free to spend my time doing whatever it is that I want to do with whoever I want to spend it with. So, and I think that comes from finding a purpose in life that aligns with your abilities and your personality, and therefore deriving happiness and fulfillment from that. I think it's interesting, because I actually think this question brings me back to the first question, one of the first questions you asked me about my lunch with Guy Spear. Because at my lunch with Guy, I asked him what I wanted to know. I said, Guy, what is the main takeaway you took about Buffett himself as a person from your lunch with him? And what Guy said to me, what I thought was quite eye-opening. He said that he realized that Warren wasn't trying to be the best investor of his generation. This was a guy who was just trying to live his happiest life. And it just so happened that Buffett's version of his happiest life was sitting in his office for 10 hours a day, 5 days a week, reading annual reports.
Right.
That was entirely conducive to his personality. And I think I was fortunate that I found my purpose in life early on as a value investor. And it aligns with the core DNA of who I am as an individual. I'm an intellectually curious person. Similar to you, I'm naturally contrarian. I like to find out why things are the way they are, and I like to ask why. And I love the constant intellectual challenge that investing presents as an infinite game. Mm-hmm. And at the end of my book, what I try to say is that, and what I often say to the students when I go and speak at the various universities and high schools is that said, there's no path to success that's straightforward. Everyone suffers setbacks and disappointments along the way. Mm. And it's having the humility to learn from those experiences, but also the perseverance to get up, dust yourself off, and keep going that's essential. Never give up.
I love it. It made me think of Richer, Wiser, Happier, William Green, as, in this pursuit of knowledge that we talked about throughout this conversation, we might get wiser. And at the end, we might do what Buffett said and find our happiness. And we just are so fortunate, and your book reminded me of it, how I get to spend my entire day reading something I would be reading anyway, and shaping in a productive way that helps people and helps grow their wealth over time, make it an enjoyable journey for them, and provide them with what we talked about at the beginning, the choices and freedom that their wealth can offer. Just the presence of it in their life, I can tell that it makes them breathe in a different way and feel lighter and live happier lives. And money doesn't give happiness, but it definitely offers a much easier life. And it's not all about money here that we talked about. We actually barely mentioned money throughout this conversation when you think about it. We talked about the pursuit of knowledge and the fun we have with it. And I absolutely loved your book. I highly recommend it. And I really enjoyed this conversation. And we only scratched the surface with the 25 questions that I asked you in the last hour and a half. But I think this audience has the right impression and a great incentive to pick up the book and read it. That's the book that I've been spending many evenings in the last few weeks with. Ardal, thank you so much for today. What a pleasure.
Thank you so much, Bogaville, for your time, but also for the insightfulness of the questions that, again, your question was, what's it like to teach? And I think that to talk about these things is to pound the ideas in, as Charlie Munger would say. So I feel like I've learned just as much from this conversation as you have.
I really appreciate it. Thank you so much. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.